In this short video, we're going to take a look at a pretty new covered call ETF, QQQI. It's really getting quite popular because of its massive dividend yield, but other people like it because it's very tax efficient, which we'll look at towards the end. Okay, so it's basically linked to QQQ, which is the NASDAQ 100. They hold all the same stocks. So that's what we'll compare it to. Now, the basics first. The inception date, QQQI has only been around since January 24th of 2024. QQQ, that ETF, goes all the way back to 1993. The price per share, $52 per share. QQQ is $610 per share. We could use QQQM, the newer version of QQQ. This ETF only has a share price of $251 per share and actually has a lower expense ratio. But let's take a look at the dividend yield. That's what people really focus on. Currently, the dividend yield, the annual yield on QQQI is 15%, and that's paid out in monthly distributions. QQQ is only 0.5%. The expense ratio is a little higher at 0.68% as compared to 0.18% for QQQ. And the 1-year total return, that would include the dividend plus the share appreciation. And the 1-year total return, this is going back 1 year from April 9th of this year. For QQQI, that's 27.07%, and for QQQ, 31.57%. Now, if we look at the calendar years, in 2024, both of those figures are going from January 24th, because that's the inception date. QQQI, the total return in that year was 19.83%, and over that period of time, QQQ 20.92%. In 2025, QQQI had a total return of 18.62%, and the NASDAQ 100 20.77%. Now, they hold all the same stocks, okay, so they are tied together. You still have exposure, regardless of which one of these you own, you have exposure to the NASDAQ 100. NVIDIA, Apple, Microsoft, Amazon, Tesla, they are all identical, all essentially in the same percentages, okay? Now, let's take a look at the total performance since the inception date of January 2024, all the way up through April 9th of this year. The dark green line is QQQI. Its total return over that entire period of time is 41.92%. QQQ, 45.24%. So not a lot of difference when we're looking at the total return over that entire period of time. But let's talk about the taxes on the distribution, because the distribution is really why people like these types of covered call ETFs. There are other types of covered call ETFs which are not tax efficient at all, but this one is. Okay, so first of all, the tax talk is only relevant if these are held outside of a tax advantage account like IRAs and 401ks. Approximately 96 to 98% of the distribution is classified as a return of capital. Now, because of their tax loss harvesting strategies and their option strategies, okay, the return on capital isn't eroding the NAV, okay? It's just classified as return of capital. What that means is when you're receiving that distribution, you're not even going to pay any taxes on that in the year you receive them, as long as you don't sell the shares. The remaining portion is subject to a 60-40 split between long-term capital gains and short-term capital gains. But in 2025, only somewhere around 2 to 3% of the total distribution would have been subject to this 60-40 split. So almost all of it is classified as return of capital. Let's take a look and see how that works. So again, outside of a tax advantage account, okay, these have a more favorable tax treatment certainly than interest income, like you would get from bond interest, CDs, high yield savings accounts. That's going to be taxed as ordinary income, which is at a typically a higher rate, your marginal rate, which is usually higher than the more favorable capital gains rates. The return of capital distribution is not taxable in the year you receive it. What it does is it reduces your original cost basis. Okay, so years down the road, whenever you sell those shares, that's when you will be subject to the capital gains, because your cost basis now will be lower and you'll have more capital gains. Because it's reducing your cost basis, the cost basis, if you hold these long enough, can hit zero, after which point any distribution you'd receive after that point in time would be taxed in the year you receive it as long-term capital gains. This essentially is just pushing your tax bill into future years. You're delaying those tax consequences until the point when you sell them. Now, for that reason, these could be used as some kind of estate planning, because let's say you hold them long enough and your cost basis is zero. If you sell, you're going to have to pay capital gains. But if you hold those and if somebody inherits those after you pass, they get a stepped up in basis. Okay, so they could sell then at that point and not have any capital gains taxes. Remember that the fund can go down in value. This is still tied to the NASDAQ 100, which can be rather volatile. Okay, the income stream, the distribution has been fairly stable, but the share price can drop in value. This has an extremely short track record. Again, it's only been around since January of 2024. The real test is yet to come. What's going to happen? How are the fund managers going to manage this if we have a period of time where maybe the market goes through 2 or 3 years of where it's slightly negative or kind of sideways? Okay, we've been in essentially a very good bull market the last couple of years while this has existed. So, but to this point, okay, there's been really no erosion of the NAV, and the distributions have been steady and has performed quite well. It's actually held up well compared to just the overall NASDAQ 100 when we look at total return also. Okay, so these are quite popular with people that just want a guaranteed monthly income that they can count on without trying to figure out when to buy and sell some shares to generate some of that income. So anyway, I hope this has been helpful. Let me know your thoughts if you like any of these, and hit the like button, and I'll see you next time.